Hi, everybody. This is Norm Boone from Mosaic Financial Partners. Thank you for joining us today. It's a pleasure to have you on this, and I hope you find the next half hour or 45 minutes useful. We're going to be talking about today's markets and what's been going on here for the last several months or a year or so, and we're going to talk a little bit about Mosaic's performance. The agenda today is we're going to talk about Greece, China, and Puerto Rico. Obviously, some things have changed here recently with both regards to Greece and China, but I want to give you some background anyway. And then for Puerto Rico, little insight there. Some of you may not be aware of what's going on in Puerto Rico, but that's another interesting disaster in the making, if you will. Also, we're going to be talking a little bit about the rising interest rates since the Fed has announced that interest rates are going up, and to just let you know kind of what our perspective on what might happen and what the implications are for portfolios. Then we're going to talk a little bit about Mosaic portfolio performance. Obviously, a well-diversified portfolio is one of our principal beliefs. And sometimes it works real well, and sometimes it hasn't. Over the last couple of years, it's been a little tough for a diversified portfolio. And I want to talk a little bit about that and give you some perspectives on that and some of the biases that we bring to portfolios. Finally, I want to talk a little bit about kind of the implications for all of that with regards to the future. And then hopefully in about 30 minutes, we'll be open and available for some questions and answers. Obviously, I need to talk a little bit about disclosures and give you some sense of all of that. If you do have questions along the way, you might want to submit your questions through the chat window, which is on your upper right part of your screen there. And Leslie, who is with me here, is going to be recording those questions so that I can address those at the end. That way you don't have to remember them along the way. In any case, let's get to Greece. Obviously, some things have happened in the last 24, 48 hours that make a big difference. But as an overview, some of the first municipal defaults ever happened in Greece 400 BC, and the Greeks have not been real good at paying their debts since that time. For the last 200 years, they've spent a significant portion of that period of time in default. So this new activity is not new. Fundamentally, the Greeks, as a cultural issue, don't pay their taxes as well as they might, and they tend to retire early with pensions. So the government has less income coming in and higher expenses going out, and that kind of formula doesn't work real well for your household or for a government. So They've really created a situation which is difficult for them. European leaders, on the other hand, are looking at this, particularly the Germans, but also some of the other northern European countries, as they fear that any real flexibility that they might show would translate to the Italians, to the Spanish, to the Portuguese, and who might ask for similar or even easier terms. And to avoid that, they've had to be pretty tough in their approach to Greece. As an overall issue, Greece's debt is about 160% of their economy, which is roughly twice the level of debt that was faced by Russia and Argentina when they each defaulted in 1998 and 2001, I believe it was, respectively. So Greece is essentially at an unsustainable level of debt, and they've needed a lot of help to get there. Obviously, the decisions that were made Monday morning with the European Union and Greece give them some hope to solve that issue. But the Greek choice fundamentally is to take that medicine or to exit the euro, and there are lots of reasons for them not to want to exit the euro, so apparently they're going to decide to take the medicine. In terms of how important is this, the Greek economy is roughly half the size of the economy of Ohio. It's not a real important deal. It represents 0.02% of the world capital markets. So again, not really important. And so economically, it's pretty minimal in terms of its impact, but politically, there's a lot of uncertainty, and that issue of contagion of if something happens to Greece that is eases up on the burdens, then what would the Italians, the Spanish, and the Portuguese, and the parties that are less adamant for living with the austerity that's being required of them, they're just concerned about that flexibility. So Mosaic portfolios have about 0.05% in Greece, at least as of a month or so ago. My guess would be it's probably a little bit lighter at this point. But even at that level, not going to have a big impact on portfolio performance. China, you may be aware, has gone through a number of changes here in the last year or so. The Chinese government wanted to become more of a free market economy, excuse me, and so they liberalized a lot of their regulations and really promoted people investing in the market. Over the last year, the local Chinese market increased from roughly 2,000 to over 5,000. In other words, about 150% in the space of about 1 year. That peaked on June 12th, and for the next 3 weeks, it dropped roughly 32%. The last few days, the market has stabilized and, in fact, recovered not a big amount, about 8% of that, but it is it is it's a political issue as much as anything else, because the real question here is not so much the Chinese economy in general, but it's how the government deals with these issues. And the government first promoted the free markets, and then when it was really challenged with this 30% drop, it chose not to allow that to happen and let the markets find itself. But literally every day, the Chinese market was creating 1 or 2 new regulations that were making it difficult for investors to sell, and were forcing trying to manipulate the free market economy. So that's really the import. And an important thing for you to understand is that the markets that we're talking about here is the local Chinese market, the A-shares market, where there is exposure in the world to Chinese markets. It's through H-shares, which are primarily sold through Hong Kong exchanges. And these local exchanges are not the Hong Kong exchanges. It's really a different animal. So as I said, that change from A to H shares, most of us have no exposure to those A shares whatsoever. So it shouldn't be too much of a concern. And the real question is, has the government lost its aura of being kind of all powerful in that process? Mosaic portfolios have had about 1.4% exposure to China in terms of the equity portion of the portfolio. So again, even though China is a huge economy, our exposure at this point is still fairly limited. Puerto Rico is the one that you may not have heard about. Puerto Rico, as you know, is a U.S. colony. Probably not the right word, but as a result, it is able to issue bonds that are tax-free, both federal and state, regardless of your state, which has made it easy to raise money. And Puerto Rico has basically put itself in a position to owe about $72 billion in debt, which is roughly $20,000 per man, woman, and child on the island. Most of its people are poor, and not this most recent weekend, but 8 or 9 days ago, the Puerto Rican governor basically announced that Puerto Rico could not pay its bills and was looking for a way out, given that as a state or as a state equivalent, Puerto Rico cannot declare bankruptcy under current tax law. So it's not real clear how Puerto Rico gets itself out of this situation. Congress right now is looking to perhaps change the law in order to relieve the burden for Puerto Rico, but they would have to do that for Puerto Rico to seek bankruptcy resolution. The unique thing about this one versus Greece and China is that the debt that is owed is almost entirely has been lent by U.S. investors, whether institutional or mutual funds, people who were looking for those higher yielding tax-free bonds. So losses would be incurred by American investors in this case. As far as Mosaic is concerned, we have virtually no exposure to Puerto Rico because we haven't been seeking those really high-risk tax-free bonds. But it is something to kind of be aware of because as the resolution for how Puerto Rico is going to find itself here, it is going to probably be in the news more, and so you've got a little bit of background on that. So now I'd like to talk about Mosaic Investments, and I'll talk about interest rates as part of that. But I want you to know that kind of a large part of how we go about thinking about our investments is really based on the long-term historical data, and we try to make our judgments based on the evidence of what the historical data tells us. As an overview, it's really been a difficult period of the last 18 months to 2 years for diversified investors. Last year, obviously, the U.S. large cap market did really well. Pretty much everything else was very weak. So when you're a diversified portfolio and you only have one sector that is doing well, your overall performance is not very good. And as a result, diversified investors in general have performed poorly over the last year and a half or so. More recently, Mosaic portfolios have underperformed even many of those diversified portfolios, and I want to talk about why that is and give you some perspective on that. In general, the economy has been slow to grow, and for a variety of reasons that I'll talk a little bit about, is probably not likely to get a whole lot better anytime real soon, partly because interest rates are about to rise. Stocks are probably fully valued in the U.S. We would not say that they're wildly overvalued, and we certainly would not say that they're undervalued, but probably fairly valued is a good description of that. It's probably less true for overseas stocks than it is for the U.S., so there may be a little bit more opportunity overseas rather than in the U.S. As far as values are concerned. And bonds, because interest rates are about to rise, are about to enter into a fairly difficult period of time. So we're looking at a little bit of a tough future here, which is one of the reasons why we think that alternatives hold perhaps the greatest hopes for reasonable returns over the intermediate term, over the next, let's say, 3 to 5 years. So as an overview here, what we have is the asset classes that we use in our portfolios, and these numbers from left to right are the second quarter from April, May, and June of this year to the 1-year numbers ending June 30th of this year to the 5-year numbers and the 10-year numbers. And what you can see on the right-hand side is that all of these numbers are reasonably attractive and worthwhile investing on. A couple of them, the U.S. stocks and some of the international stocks have done well over 5 years, but when you start to get into 1 year, you begin to see some negative numbers, and there are fairly low and negative numbers over the second quarter. In particular, large U.S. stocks hardly were positive at all. In fact, the Dow Jones Industrial Average was negative in the second quarter. Small stocks were a little bit better. And then when you go into international stocks, the small stocks had a reasonably attractive quarter, but pretty much everything else was negative or weak. It's an interesting contrast to last year, 2014, when U.S. large cap stocks did so well. Small cap stocks did minimally okay, and the international stocks were negative almost exclusively because of currency valuations. If you were a European investor investing in European stocks, you had a pretty good year. But as an American investor investing in European stocks, you lost money because of the change in currency rates. So just by way of history here, gives you some perspective on the thesis here that I'm positioning. And that is that really this last year has been an unusual period of time for most of the asset categories. When any investment manager puts together portfolios, there are certain biases that get built into the portfolio, and we have our own as well. For example, we mimic the proportional value of the world capital markets. And by that measure, the U.S. is about half of the market. Emerging markets are about 14% of the market, which leaves about 36% of the market to the developed world outside of the U.S. And that's the way in which we structure our equity portfolio. Most of the time, that's worked for us real well. Last year and year to date, that's been a little bit more difficult period of time. Bonds, we break them into short-term and intermediate maturities. We don't include longer-term maturities because of the volatility, and we break them into various parts. When interest rates, well, we'll talk about interest rates in a second. So anyway, that's the structure that we use. And then currency movements in the last 18 months, because the dollar has gotten stronger, largely since June of 2014, when there was a combination of the oil price changes and some of the export changes, and U.S. was producing more oil, and the dollar got stronger, and both Europe and Japan started doing their own quantitative easing, and so created a lot of liquidity in the markets. All of those things made for a fairly sudden change in the way in which currency movements happened and the exchange rates happened, which hurt U.S. investors investing overseas. And finally, alternatives, which are intended to reduce overall portfolio volatility and lessen dependence on bonds in order to accomplish that, have, we believe that over the long run, they're an important part of a portfolio design, but it's been a difficult period, which we'll talk about. So first, let's go to interest rates. This is a chart that shows the Fed funds rate over the last 15, 16 years. And you can see that it's gone up and down right before the 2007 beginning of the Great Recession. The Fed funds rate had gone up to about 5.25%, and then it came down pretty quickly. And since that time, it has been flat at 0.25%. So when Janet Yellen, who is the chair of the Federal Reserve, talks about raising the rates, it becomes a pretty big deal because it's been so stable for so long. What you can see here is this dotted line in the blue chart here, if you can see the colors, is what the Federal Reserve governors project is going to happen over the next few years in terms of their rate increases, whereas this lower dotted line is what the market expects for the next few years. You can see that the market thinks that the rates are going to be a lot lower 2 or 3 years from now than the Fed governors think. But in both cases, everybody expects that rates are going to rise, and relative, starting from 0.25%, all of those are pretty substantial increases. And then finally, just by way of comparison, this 3.25% number is the long-term projection that the Federal Open Market Committee projects for long-term rates, which would be the base rate for interest rates for other bonds in the future. And the higher that is, it means the higher that other bond interest rates are going to be, which means that there will be a continued climb in interest rates for 3 to 5 years. So if rates rise, what happens? And let's go back to the math here. The return on bonds is equal to the percent of price change up or down that you get because interest rates, when interest rates go up, bond values drop. And so if interest rates go up, that means that we'll have a loss or a negative number in that price change, and then plus the interest rate yield, so that if we lose 1% in bond values and we get 2% in interest, the return for bonds for that period of time would be 1%. And obviously, the more price change there is, because the more interest rate there is, then the tougher it's going to be in terms of getting positive returns from our bonds. The implication implication here is really that until rates stabilize, bonds are likely to produce minimal returns. The yield can only provide so much, and then we're offset by the loss in bond values as interest rates are rising, and so returns are going to be fairly minimal for probably the next 3 to 5 years. That doesn't mean that you need to get out of bonds. Bonds do provide a lot of stability to a portfolio, and one of the real values is when stocks go up and down, bonds tend to oftentimes move in opposite directions, and that can be really helpful in terms of strengthening an overall portfolio. So let's look at some real examples here. These are 3 different examples from June of 04 to June of 06, in 1999 to mid-2000, and from February of 1994 to February of 1995. During those periods of time, the interest rates went first from 1.25% to 5.25%, from 5 to 6.5%, from 3.25% to 6%. Each of these are the last 3 times that the Fed has raised interest rates, so it gives us some sense of what's likely to happen. The return for short-term bonds over that period of time was 4% for a pretty large movement. So you can see that it wasn't a really big negative impact for short-term bonds. And similarly, in the other 2, 3.1% and a positive 1.1%. So in all 3 of those cases, short-term bonds were positive in terms of their returns. And intermediate-term bonds, again, were fairly positive in this most recent rate rise period, and a little positive and then slightly negative in the 90s when interest rates rose. So I want to make sure that kind of people aren't running for the hills here because oh my God, interest rates are going to rise and so bond values are going to fall disastrously. It's clearly not a disaster, and in fact, the odds are pretty good that we'll still have relatively positive returns here. They're just not going to be exciting and enticing kinds of returns in the process. If rates rise, what happens to stocks? Well, there's different impact on different industries. Financial companies can get more profitable. I was at a Schwab conference a couple of weeks ago, and Schwab was talking about how much more profitable they're going to be if rates just rise by 1/4%. And that would be true for banks, for a lot of the financial services companies. On the other hand, heavy borrowers are going to pay more in interest. Companies with large cash balances win because they get the interest income. Consumers with large savings can spend more. The cost of capital for investments to create more productivity will increase, and mortgages will become more expensive. So again, there are going to be some winners and there are going to be some losers in the process. History has seen rising and falling markets in that kind of when interest rates rise. So it could happen in either way, but more often than not, particularly when rates rise slowly and at the early stages of those periods, it's actually been positive for stock markets. So our feeling is that what we're going to see here is a slow, cautious rise in interest rates, and the results of that will be positive but minimal bond returns, and that stock markets will have more winners than losers, and that on balance, it'll be good to be invested in the stock market over that period of time. So one of the things that drives stocks, obviously, is how well the economy does. And I want to talk a little bit about kind of where stocks are in that process. We've had a slow recovery from the Great Recession. As you know, the Great Recession started in 2007 and ended March 9th of 2009. And the recovery from that has been as slow as any recovery from a recession in the last century or so. The overall economic growth rate has been about 2 to 2.5% on average over that period of time per year. Now, it's interesting because when you break that out into what's happened, kind of from businesses and consumers and government, it's actually been the government, shrinking back and pulling back and actually losing jobs, both local governments and state governments and federal governments, and that the growth has really happened in the private sector. If you just look at the private sector, the growth has been about a positive 3% per year over those periods of time. Right now, corporations are healthy. They've got lots of cash. Roughly 30% on average of their assets is in cash right now. As a result, they've been investing more in equipment and capital events that will help them grow, and their profits have been growing to record levels relatively recently. And consumers are also in great shape, perhaps even better shape. And unemployment is down, so more people are working. Their debt service is as low. In other words, the amount of their income that they're using to pay off their loans, that debt service is as low as it's been in a very long period of time. Interest rates are low, so it makes it easy for them to borrow. And as a result, housing prices have continued to rise. Inflation continues low, and consumer attitudes right now are very positive. So consumers are in great shape, corporations are in great shape, but economic growth over the long run comes from having more workers and more productivity, and the outlook for both is relatively poor. Just the demographics of the American population are such that there are fewer, relatively speaking, workers coming into the market, and we've kind of closed the doors to immigration. So we're not bringing in, relatively speaking, a lot of new workers to the workforce. And the rate of productivity growth, unless we have a whole new wave of automation or something like that, productivity growth seems to have slowed, so that we've got slower growth from fewer workers coming in and slower growth from productivity. So there's not a lot of reason to think that there's going to be a high level of economic growth coming up here in the near future. So stocks are generally driven by the profits of those companies. The more profitability that is shown in a corporation, the higher its stock is typically going to be. And so it's worthwhile looking at profitability. This chart shows the amount of profits that have happened up into the period of time in 2007. Obviously, profits started to drop, and for one quarter, because of the big losses in the bank, they actually went negative. And since then, they've grown and continue to grow to really historically positive levels, and are expected to rise again here in the near future. That said, with higher profits, pricing is not out of line. The price-earnings ratio, which is the relationship, obviously, between the stock price and the amount of earnings that a share has proportional to the company, right now is about 16.4 times the anticipated earnings of companies, whereas that average has been about 15.7% over the last 25 years. So we're not really out of line there. We're also kind of right in the middle for a longer-term price-earnings ratio called CAPE. The dividend yields, price-to-book ratios, price-to-cash flow ratios are also very much in line with where we are historically. So we would say that stocks right now are fairly valued. They're not excessively valued over or certainly under at this point. So there's reason to feel comfortable, not be worried about, oh my gosh, there's going to be a crazy crash coming on. Short of surprises, the stock market should continue to grow as profits grow, but it'll be at a relatively slow level rather than a fast level. This chart shows the history of the S&P 500 since the year 1900, and what you can see for the most part, over these last century or so, is that things are relatively steady. They go up and down, kind of in the interims, but they're kind of flat for a while, and then they go up, and then they're flat for a while, and then they go up, and they've been flat for a while from 2000 to current. And maybe we're on a slow trend upward, or maybe this flat line will continue for a while. But just to give you some perspective on kind of where the market is, it is a slowly trending upward, but consistently trending as long as you have a long-term perspective on how things are going. So I mentioned currency translations as being an important element of last year's returns, and to an extent the first quarter in particular of this year. And what I want to show you is that the impact, if you look at 2014 and you just look at EFA, which stands for Europe, Australia, and Far East. So in other words, the whole developed world outside of the U.S. In local terms, which means if you were a Frenchman investing in European stocks, or an Australian, or somebody in Japan, and you were investing in your local market, your markets did pretty well. In this case, on average, you were up 6.4%. U.S. investors investing in exactly the same companies in exactly the same way would have lost 4.5%. And that differential of a little bit more than 10%, almost 11%, is a result of the currency translations that came up last year, particularly in the last half of last year. Primarily happened when the oil prices changed and the U.S. stopped putting liquidity into the market, and the Europeans and Japanese started to put money into the economies to support their own economies. This year it's been a little bit better, but the same story has been true. The local investors investing in their local markets year to date have gained about 9.2%, whereas if you were a U.S. investor investing in the same thing, you're only up 5.9%. Again, not bad, but relative to what local investors have done, not nearly as good, and that's solely because of the currency translations. Now, sometimes it works the other way, and it works in the U.S. favor when the dollar value is dropping. But if you've done any traveling overseas in the last year and a half, you know that the dollar is getting stronger, and that's attractive when you're traveling. But as a U.S. investor investing overseas, it makes things more difficult. So let me talk about some of the things that are going on specifically within the Mosaic portfolios, and what I call biases or choices that we make with portfolios are going to show up here. So the first of those biases is diversification. Diversification is really central, and this is kind of a confusing chart unless you look at it in real detail, and I don't mean to do that, but each of these different boxes represents a different kind of investment strategy, and each of the columns represents a calendar year. And so we've got commodities, and we've got fixed income, and we've got high yield bonds, and real estate investment trusts, and cash, and emerging market equities, and developed market equities, equities being stocks, small cap stocks, and large cap stocks. And what you can see is, if you follow those colors, is there's virtually no pattern. It's hard to predict what's going to be next, what's going to be successful, and what's not going to be successful. And the things that were real successful, kind of a few years ago, the commodities, for example, were at the top 2 out of the 3 years here. They've been down near the bottom, and they're in the middle for some years. And similarly, REITs, sometimes are positive and sometimes are down at the bottom, et cetera. And really the only resolution to that is to not put all your eggs into one basket. And that's really what diversification means. It's why it's a central part of our portfolio. And when you go through a year like last year, when the U.S. large cap market, which is the market that gets all the headlines in the U.S., does as well as it did, and you're diversified, you're simply not going to do very well. And that was true for all diversified investors last year, is that they didn't do nearly as well as the large U.S. stock market did. So other portfolio biases that we have is based on the data. And small caps have historically outperformed large company stocks, both in the U.S. and overseas. So relative to what the market suggests that we would do, we hold larger percentages of small stocks in our portfolios. Value has historically outperformed growth, both in the U.S. and overseas, among small and among large stocks. And so we hold a slight amount more of value than we do of growth in each one of those sectors. We also follow a fundamental index structure, which is different than the market-weighted indexes. For example, the S&P 500, the the company that is the largest, Apple these days, if you multiply the number of shares outstanding times its share price, it is the most valuable company in the world, actually. And as a result, it has the largest position. I believe it's 6 or 7% of the S&P 500 is weighted to Apple. The fundamental index doesn't look at the market price, but it looks more at things like sales and book value and profitability. And as a result of that, it has, for the most part, the same stocks, but it will reorder how it's held and what the proportionality of ownership is. And that fundamental index has historically outperformed market-weighted indexes, both in the U.S. and overseas, small and large stocks. And then alternatives have historically mitigated the volatility while providing attractive returns. Well, all four of those biases have not worked as well for us recently as they have historically, and we're convinced that this is really kind of a temporary thing, but it's a tough thing to go through. So let's talk about some of those specifically. Small stocks have outperformed large stocks over time. So since 1979, small stocks have outperformed large stocks by 1.8% per year over that period of time. This chart shows above the line is when the small stocks have outperformed large stocks, and below the line is when large stocks have outperformed small stocks. And roughly half the time, small is outperforming large, and the other half, large is outperforming small. But on average, because of the outsized gains, mathematically, the small stocks have outperformed by 1.8%. What you can see is that most recently here, the cycle has been down so that large has been outperforming small. Again, there's no reason to believe based on that pattern that that will continue to be the case, but it certainly has been frustrating to go through. Again, that same pattern exists, in the U.S. And overseas, but recently large has been better than small. Similarly, value has outperformed growth, and here's a chart for large U.S. stocks where value has outperformed above the line and growth has outperformed below the line. And on average, for large stocks, growth has outperformed. Value has outperformed growth by 1.16% per year since 1979. U.S. small stocks, value has outperformed growth by about 3.2%. And international large stocks have outperformed by 2.8% per year over that same period of time. But in all of those cases, you can see that recently that growth has outperformed value here a little bit. Again, it's a cyclical nature, and we fully expect that that's going to be changing at some point in the future, which we will appreciate sooner rather than later. And then looking at the fundamental indexes versus the standard benchmarks like the S&P 500 or similar funds for different sizes. For large international stocks, the fundamental index has outperformed the standard benchmarks by almost 3% per year. For large U.S. stocks since 1979, the annual outperformance has averaged about 2.4%. But again, what you can see is that recently, this last year and a half, that has not been the case. So these things are all cyclical, but the cyclicality on all of them has worked against us. Then finally, I know a lot of you have questions about the alternatives, and legitimately so, given the performance over the last few years. I don't expect you to read this chart, but kind of it's important for you to know that we really look at the statistics here, and the statistics are that one of the reasons why we use alternatives is this chart, and this chart suggests that there's very little relationship between a number of the alternative choices that we make and U.S. stocks or other kinds of stock holdings or primary bond holdings, and the less the statistical relationship, in other words, when U.S. stocks or other stocks are going up, do these alternatives tend to also go up at the same time and to the same degree and for the same reasons? And the less that's the case, the more attractive it is to a portfolio, because it means that when one thing is zigging, the other thing has likely to be zagging. And that combination, again, it's like not having all your eggs in one basket, gives you the benefit of having a smoother ride. And when you have a smoother ride, your portfolio has better returns over time. So actually, managed futures is the alternative strategy that is the least correlated to stocks and bonds, followed by commodities, emerging market currencies, emerging market bonds, and master limited partnerships, which are the oil and gas transmission pipelines. So those are all theoretically attractive elements historically to help a portfolio. Some of you may have seen this chart before, but this is the chart that represents the bear market from 2000 to 2002. And this little center point, if you will, here represents the S&P 500. So the S&P 500 during that two and a half year period of time lost roughly 22% or so per year during that period. And its level of risk was, let's call it 28%. All of the alternative strategies had better returns than just a pure stock portfolio. And most of them had much less risk over that period of time as well. In fact, some of them had not only less risk, but actually produced positive returns over that period of time. That's what we're looking for. We want something that zigs when the stock market is zagging. And during that period of time in particular, it worked really well. In the 2007 to 2009 period of time, managed futures, were up in this corner. The other ones still produced better returns than stocks, but weren't necessarily, helping the portfolio nearly as much as it did in the time before. This chart points up, kind of the historical returns here from 1987 to June 30th of 2015. You can see all of these returns are all pretty positive here. These are from here on up, the different alternative strategies that we use in our portfolios. This takes all of the above ones and equally weights them. So what is the average return of those different strategies? And the average returns for an equally weighted alternative portfolio using these strategies since 1987 would have been above 12% per year, whereas the S&P 500 during that period of time was at about 10.25%. So you can see that there's historically a reason to believe that alternatives are not only good for a portfolio because of risk issues, but also because of return issues. That relationship between what alternatives did and what stocks did for the last 15 years has also held. Over the last 3 years, it's been a pretty weak relationship, and you begin to see red numbers here in 2014 and even more so year to date in 2015. Again, we believe that this is simply a cycle that we're going through, and that for each of these, there are reasons why the cycle exists, but we think this is a relatively temporary issue. Another way to look at this is if we take over the last 28 years and we divide them into 4 categories. For example, the first one being time categories from 1987 to the end of 1993, and then from 94 to 2000, from beginning of 2001 to the end of 2007, and then the most recent period here through the end of 2014. You can see that for the first 3 periods, for the first 21 years, which one does better and which one does worse changes, but they were all pretty attractive returns, this being the 10% line here. Whereas this last 7 years since the Great Recession has been much more difficult period of time. Again, we think there are some unusual forces that have gone on that are unlikely to continue. So in summary here, kind of what are our lessons? For Greece, China, and Puerto Rico, they're worth watching, but they're each, for their separate reasons, unlikely to cause notable harm. Obviously, the resolution in Greece looks like it may be on its way to working. China, the last 3 or 4 days in that market has stabilized and turned positive, so probably nothing to worry about there other than the internal government and political implications. And then Puerto Rico is worth watching, but again, it's not part of our particular portfolios. Interest rates are ready to climb, but they'll probably do so slowly. That will rein in bond returns until rates stabilize, and it could actually help stocks. Stocks are pretty fully priced at this point, but the engines for faster growth aren't readily apparent. We expect low positive returns on average over stocks over the next 3 to 5 years or so, and our biases, we believe, should provide some benefit. Biases being value over growth, small over large, etc., that we talked about. Currency changes can overwhelm everything else, and it's just hard to predict which way that's going to go. The net impact on currency changes is sometimes it's positive, sometimes it's negative, and over time it kind of goes away. But during short periods of time, it can be an important element. Diversification sometimes hurts, but it over the long term, having all your eggs in one basket is not a good strategy. So diversification is an important strategy to continue to hold. And the alternatives, I would just encourage you to not lose faith. It's been a real tough period, and we think there's a pretty good chance that it could be the favored area over the next phase of the market. So, the more we can stick with the program, we think the better off we are. And with that, I'm going to take some questions, and I appreciate your being here and sharing some time with us. So one of the questions that we got, did you say that Mosaic diversified portfolios performed lower than average, and if so, what changes have been made to improve things? And I did say that diversified portfolios in general have performed poorly over the last year and a half, and that because of the biases that we have, Mosaic portfolios on average have probably underperformed most diversified portfolios. A simple example of why that is, if you compare our portfolios, which have 50% equity exposure to the U.S. stock market, to a portfolio that has 70% equity exposure to the U.S. market, that other portfolio is going to do better. So that's a bias that we have in terms of how we choose to do that. Over the long run, we think it will work in your favor, but it has been to our disadvantage over this period of time. Similarly, for value versus growth, the small versus large, the fundamental, each of those things, again, cyclically has been difficult for this last year and a half. Our job really is to provide that perspective to help you, stay disciplined on things, so that in the long run, the kinds of what we might call truths that the longer term history suggests to us are the things that you follow and that will help you in the long run, rather than panicking because of a short term difficult period. And so we have not made a lot of changes. We are kind of constantly looking at those choices and other choices to see whether it will serve you best in the long run. And periodically we will make minor changes, but kind of those fundamental beliefs, unless the statistics and the data tells us that we should be doing something different, we think that you and we ought to be sticking with the program. And I say we because pretty much all of the Mosaic employees are invested pretty much the same way that all of you are in Mosaic portfolios. We have another question about unemployment numbers and whether they've been doctored. There's a reference to some people talk about numbers of 10 to 15% unemployment, and that's really a function of you're kind of talking different statistics. The official unemployment rate right now is 5.3%. That means that 5.3% of all Americans who are working or who are looking for work do not have jobs at this point. If you count those people who are eligible to work but aren't even looking, or if you count people who are working part-time but really want full-time jobs, then that number rises to above 10%. I believe that number is 11 or 11.5%. And so the official number is at 5.3%, is not doctored. It's simply a different statistic measuring different kinds of things. Obviously, a higher level of people who are not working, who would really like to be working even though they may not be looking, or people who would like to be working full-time but can only find part-time jobs. That's not a satisfactory situation, and it points up the weaknesses of the economic recovery that has happened since the beginning of the recovery in 2009. It hasn't been as strong as it might be, and that goes back to what do you do to get an economy growing? And that's adding more workers who are qualified to do the jobs that you need them to do, and finding ways to help them be more productive, whether it's investment in automation and technology or just capital equipment of one sort or another. The more of those kinds of things we can do, the better, and the economy has been slow to grow in that regard, so we continue to have some of these problems. I think that pretty much does it in terms of questions that we might ask. So I appreciate you all taking the time to listen in. I hope you found this useful. We'd love to hear some responses from you about this. I believe that we are going to be sending you an email that you'll get either this evening or tomorrow, and we'd love to get some responses and feedback, so that if this was useful and that you think we ought to be doing more of these kinds of things, clearly we can, but we'd love to know what your thoughts are about it. Again, thank you very much for your time and your interest, and I look forward to talking with you individually.